Okay, so you want to own a bank. I completely understand the appeal. To the average person looking from the outside, it sounds like the absolute ultimate financial cheat code. People literally walk in off the street and hand you their hard-earned money. You take that cash, you lend it to someone else at a much higher interest rate, and you just sit back in a tailored suit behind a massive mahogany desk and collect the difference. It sounds like a beautifully simple, risk-free, completely legal money printing machine. You control the vault, so you control the world, right? Wrong. Let me completely destroy that illusion for you right now, because what you are actually stepping into is one of the most mathematically terrifying, highly volatile, and psychologically fragile business models ever created by human beings. Most people picture a bank as a highly secure, static storage room. You bring your $100 in. They put it in a heavy steel box with your name on it. They guard it with armed security, and you take it out when you need to buy groceries. But that is not a bank. That is a locker. A bank is a highly aggressive, relentlessly churning engine that takes other people's money and aggressively transforms it into income-producing assets. Every single dollar you deposit is absolutely not sitting in a box waiting for you. The exact microsecond your deposit clears the system, it is ripped away and put to work. Think about traditional industries. A massive steel mill buys raw iron and melts it down to manufacture car parts. A factory buys plastic to manufacture toys. But in the banking industry, the raw material is other people's money, and the product you are desperately trying to manufacture and sell is debt. And here is the part that makes banking genuinely, fundamentally different from almost any other business on the face of the earth. When a bakery sells a loaf of bread, the flour is completely gone. But when a bank lends out your deposit to a stranger buying a house, your deposit is somehow still there. You can log into your banking app right now, look at your screen, and see your money. You completely believe you can withdraw it tomorrow morning. As far as your brain is concerned, it hasn't gone anywhere. But the brutal mathematical reality is that the bank has already lent 90% of it to somebody else. This is not a scam. This is not fraud. This is the bedrock of the global financial system called fractional reserve banking. You deposit $100. The bank legally keeps a tiny fraction of it and blasts the rest back out into the economy. They operate on one singular, terrifying, calculated assumption that not everyone will panic and ask for their money back on the exact same day. You are generating astronomical returns, but you are doing it on capital you do not own. This is called leverage, and leverage is the financial equivalent of driving a sports car at 200 miles an hour with no seatbelt. It is the absolute source of banking's unimaginable profitability. And it is the exact same mechanism that makes it capable of collapsing into absolute dust in a matter of hours. But before you even get the chance to play this dangerous game, before you collect a single penny of interest, you have to survive the bureaucratic bloodbath. And the price of admission is staggering. Let us look at the brutal, unvarnished reality of what it actually costs to build this machine. You probably think you just need a big pile of cash in a nice marble building downtown, right? Think again. Before you are legally allowed to take a single deposit from a single customer, before you make a single profitable loan, you are going to bleed millions of dollars in pure, unrecoverable sunk costs. You are stepping into one of the most heavily guarded, ruthlessly regulated, and fiercely protected monopolies on the planet. You cannot just declare yourself a bank. You are forced to navigate a soul-crushing labyrinth of federal and state bureaucracies. You have to beg for a charter from the Office of the Comptroller of the Currency. Then, you have to separately beg the Federal Deposit Insurance Corporation, the FDIC, for deposit insurance. You will spend between 1 and 3 years of your life filling out thousands of pages of mind-numbing documentation. You must justify your entire business plan, expose the financial history of every single person on your management team, and prove your complex risk framework. And they will look for every possible reason to reject you. And then, We hit the absolute brick wall of capital. Do not confuse capital with deposits. Deposits are liabilities. That is money you owe to your customers. Capital is the money that actually belongs to you. It is the heavy financial armor that absorbs the brutal losses when the market inevitably turns against you. If you want to build even a small local community bank that can aggressively lend out $100 million, regulators will force you to lock up $10 to $15 million of your own capital before you even open the front door. You cannot borrow this money. You cannot leverage it. It has to be pure, hard, unencumbered cash. And that is just the cost of existing. Now, the daily bleeding begins. A functioning bank is an operational nightmare. You are instantly drowning in astronomical payroll costs. You need elite risk managers, ruthless compliance officers, branch staff, and internal auditors. A tiny bank burns millions a year on salaries. A massive global bank burns billions. Then, there is the invisible war zone of technology. Modern banking is no longer about physical vaults. It is a highly advanced, heavily targeted cybersecurity war. Fraud is constant. Hackers are relentless. A single microscopic data breach can completely vaporize your reputation and cost you hundreds of millions in federal fines. You are forced to spend a fortune on state-of-the-art core banking software just to keep the digital lights on. And finally, you are hit with the cost of bad loans. Every single time you lend money, you mathematically guarantee that a certain percentage of it will never come back. Businesses go bankrupt. People lose their jobs. The housing market crashes. You are legally required to set aside massive piles of cash in advance to cover these inevitable losses, known as loan loss provisions. You have not earned a single dollar yet, but the meter is running, and you are burning hundreds of thousands of dollars every single month. To survive this massive cash burn, you need an engine. You need to squeeze profit out of thin air, but the engine you are about to build is completely at the mercy of forces you cannot control. So, how does this massive, expensive, highly regulated machine actually generate billions of dollars in profit? The entire global banking empire relies on a seemingly invisible mathematical gap called the net interest margin, or the spread. The mechanics are almost insultingly simple. You borrow money cheaply from desperate depositors by giving them a pathetic 1% return on their savings account. Then, you immediately turn around and lend that exact same money to a desperate homebuyer at 7%. You sit directly in the middle of the transaction, and you mercilessly harvest that 6% difference. That spread is the absolute lifeblood of your entire operation. If you manage a loan portfolio of $500 million and you maintain a 3% net margin, you are generating $15 million in pure interest income every single year. When you multiply that tiny percentage across trillions of dollars of assets at the megabank level, small microscopic numbers instantly transform into completely inconceivable sums of wealth. But you do not stop there. Oh no, the modern bank is a master of extracting value from every single human interaction. You build an intricate, unavoidable web of fees. You charge monthly maintenance fees just to hold their money. You charge exorbitant wire transfer fees. You collect billions of dollars globally in predatory overdraft fees, punishing people simply for running out of money. And every single time a customer blindly swipes your bank's shiny plastic debit card at a grocery store, you silently extract an interchange fee from the merchant. It is a brilliant, frictionless toll booth placed on the highway of the entire global economy. When the weather is clear, when the economy is booming, it feels like you are an untouchable financial god. You are printing money. But here is the devastating trap hidden beneath the floorboards. Your entire massive billion-dollar profit model is heavily dictated by a small committee of people sitting in a room in Washington, D.C., completely outside of your control. The Federal Reserve sets the baseline interest rates, and when those rates violently shift, your entire math formula can completely vaporize overnight. Imagine you locked billions of dollars of your customers' deposits into safe, fixed 30-year mortgages paying 3%. You think you are secure, but suddenly, inflation spikes. The Federal Reserve aggressively hikes interest rates. Instantly, your depositors realize they can get 5% yield somewhere else. To stop them from pulling all their money out of your bank, you are forced to raise the interest you pay them. But wait, your income is still completely locked into those old 30-year mortgages paying only 3%. In a matter of weeks, your beautifully calculated net interest margin collapses. It flips upside down. You are suddenly paying out more money to hold deposits than you are earning from your massive loan portfolio. Your unstoppable profit engine is now hemorrhaging cash. You are trapped in an absolute financial nightmare called an asset-liability mismatch. You look completely fine on paper, your building is beautiful, your staff is smiling, but deep inside the balance sheet, you are slowly bleeding to death. And in the banking industry, when the bleeding becomes visible, the end does not come slowly. It comes with terrifying terminal speed. If a normal business fails, a restaurant or a tech startup, it usually dies a slow, predictable death. Customers slowly stop coming. Revenues decline over years. The CEO eventually runs out of runway and files for bankruptcy. But banking does not die of natural causes. Banking dies of sudden, catastrophic heart attacks. Because at the absolute core of everything we have discussed, beneath the complex algorithms, the massive skyscrapers, and the heavy regulatory armor, a bank is purely 100% reliant on a completely invisible, highly fragile emotion: trust. The exact second the public loses trust in your institution, the math no longer matters. The capital requirements no longer matter. You are finished. Look at Washington Mutual in 2008. They were an absolute titan of the industry. They had $188 billion in deposits. They had over 2,000 branches. They had survived decades of economic cycles. But when the housing market collapsed and toxic subprime mortgages poisoned their balance sheet, panic infected the public mind. Fear spreads faster than any virus. In just 10 brutal days, terrified depositors violently ripped almost $17 billion out of the bank. The bank completely imploded. A financial empire built over 17 years was violently erased from existence in less than 2 weeks. But if you think 10 days is fast, welcome to the terrifying reality of the modern digital age. Look at Silicon Valley Bank in 2023. They were the 16th largest bank in the United States. They had over $200 billion in assets. They were holding the cash for the most elite, technologically advanced startup founders on the planet. But they fell into the exact asset liability trap we just talked about. They locked billions of dollars into long-term government bonds. And when interest rates violently spiked, those bonds lost massive amounts of value. When a few elite venture capitalists realized the math was upside down, they didn't line up outside a physical branch. They opened their phones. They sent a few messages to private group chats. A digital stampede began. In a single day, customers smashed the withdraw button on their apps, attempting to pull out $42 billion. The bank had operated successfully for 40 years, and it was completely, brutally annihilated in exactly 44 hours. This is the ultimate mind-bending reality of owning a bank. You are not building a stable, predictable corporate empire. You are building a highly leveraged, incredibly dangerous psychological pressure cooker. You are operating a machine that magically transforms collective human trust into immense personal wealth. You collect a heavy toll on every single transaction in the global economy, and you generate returns that outpace almost any other industry in human history. But you must never, ever forget the absolute golden rule of the vault. The leverage that makes you a billionaire is the exact same leverage that will wipe you out. You are playing a high-stakes game of musical chairs with other people's life savings. And the moment the music stops, the moment the invisible thread of confidence inevitably snaps, absolutely no amount of capital, no algorithm, and no steel vault in the world can save you from the crash.